Most people spend their entire lives trying to make more money. They work harder, they save, they invest, they put money in a 401k, and somehow they still end up worried about whether they're going to have enough. So maybe the problem isn't how much money you're making. Maybe nobody ever taught you the rules. Because there are certain laws of wealth that show up over and over again in the way wealthy people think about money. How they protect it, how they put it to work, how they maintain access to it, and ultimately, how they turn money into income they can't outlive. In this video, Brian is going to walk you through 6 of those laws. And I want you to pay very close attention to the last few, because this is where the entire conversation about retirement starts to change.
On this webinar presentation, we're going to be going through the 6 laws of wealth to start us off with. Then we're going to be going through another topic, which is annuities, because a lot of what we focus here at the BYOB team is obviously infinite banking, how to replace your banking functions in your life through specially designed whole life insurance policies. But we also focus on other strategies. So the first thing that we're going to be covering here is the 6 laws of wealth. And these laws these really are not like financial tips or things like that. These are actually laws. These are principles that we definitely recommend that you follow, because these have stood the test of time, so to speak. And these laws are how, like, the wealthy, by the way, create leverage while other people, say, kind of cling to fear, right? And so these are very potent. And we're going to walk through these here. And then if you guys have questions on these, definitely chime on in. All right, because here's the thing. So when the economy crashed the last time, people had liquidity. Some people did. A lot of people did not have liquidity, and that was very hard to survive if you don't have liquidity. So a part of these laws is to make sure that when things happen in the economy, in the markets, because they do go up and they do come down, but when we have these tough times, which we kind of feel like we're headed into right now, these laws become even more important in your financial life. All right, so let's go ahead and dive into these right now. So the first law, pay yourself first. Now, what do I mean when I say pay yourself first? So most people, when money comes into their hands from whether it's a W-2 job, whether it's from your business, whatever it is, they pay everybody else first. Then whatever's left over is what we pay ourselves. That's savings. And that is kind of backwards when you think about it. So one of the first laws, pay yourself first, is so that you are treating yourself better than the people that you're paying other monies to. Because when a recession hits, those with cash, not credit by the way, those with cash or liquidity are the ones that win. And infinite banking is one of the most important ways to pay yourself first. Because think of like a 401k. Now a 401k oftentimes is another way that people pay themselves first. If you have income or W-2 job, they take that 401k amount out of that and they put it into that 401k fund. So you're paying yourself first. But here's the thing. When you think about a 401k, do you control it? No, you don't. Is it a liquid asset? No, it is not liquid, because you cannot liquidate it without penalties. And sometimes if you're employed with an employer, you cannot even liquidate that 401k. It's locked in. You cannot even touch it, right? So pay yourself first, but make sure that it's benefiting you. So the other things about 401ks is they're also tax deferred. So you're going to pay taxes down the road and those kind of things. But the biggest thing about those kind of things is they're not liquid. It's not liquid. There's no liquidity. But with an infinite banking policy, specially designed, of course, with cash value, it is considered a liquid asset. And so I've had a lot of clients say, well, Brian, after everything's all said and done, every month I have this much left over to put into a policy, to infinite banking, start building that cash value. And by the way, we're going to go through infinite banking here in a little bit later. So if you don't understand all the ins and outs of it, that's fine. I'm going to go through and explain and show you some actual examples of illustrations and how these things work. And then also before that, they're also going to go through some annuity education as well. But those are liquid assets. And so I remember I had a lot of clients back in 2008 and 9 that had policies. And I remember them telling me that when everything went, to crap, I guess you can say, they had liquidity. So when we came out of that recession and real estate was very cheap, but nobody could get loans from the banks to get the real estate, those with liquidity, infinite banking, by the way, were able to buy assets. And I remember there's a gentleman by the name of Ken McElroy. Some of you might know who Ken McElroy is. He's a very successful real estate investor, and he's also one of Robert Kiyosaki's advisors. So he's his real estate advisor. And I was talking to Ken, this was many, many years ago, about how he dealt with the recession after 2008 and 9. And he was telling me that he had infinite banking in place, by the way, So he had liquidity, but he had a whole lot of it call it private lenders that also had liquidity, or they had infinite banking in place. And what happened was, is as they came out of the recession, he used his liquidity, his infinite banking policies, and his private lenders to gobble up real estate for pennies on the dollar. He was telling me he was buying properties for like 30 cents on the dollar. So that's very cheap. And he told me that he quadrupled his real estate holdings after 2008 and 9, which is staggering. When everybody else was scrambling, trying to make ends meet, he had liquidity and was buying cash flowing assets like crazy. And his net worth obviously went up and all that kind of stuff. So having liquidity is a big deal. So what I want to do right now, and so by the way, so what infinite banking allows you to do, and I have clients that say, hey, I only have this much left at the end of each month. What I tend to ask them is this. I said, well, wait a second. Let's say that you have a $500 bill that all of a sudden has to be paid every single month. What would you do? Well, Brian, if I had a $500 bill, I would just adjust all my finances. I'd have to probably, stop paying this, subscription to, this streaming service or something like that. They would absorb the $500 is what they said. I said, so wait a second. So if you're saying that you have this much left at the end of each month, what if we change the way we say this? What if we say, hey, we're going to pay ourselves first, $500 per month as an example, into a policy. And then they adjusted their expenses to meet that. And it was just a different way of thinking about it. But what I want to do is I want to do a quick little poll here real quick. So what I want you to look at this question right here that's on the screen. What percent of your income do you currently save before paying your bills? So use the comment box. So A, is it 0%? B, less than 10%? C, is it 10 to 20%? Or is it D, more than 20%? So once again, rule number 1, pay yourself first. All right, let's go ahead and go to rule number 2. So rule number 2 is make your money work for you. Now, what do I mean by that? So most people, when we go through life, we're taught to trade time for money. We spend most of our life trading time for money and taking a little bit of that money and putting it aside so that down the road, this is called retirement, by the way, we can stop trading time for money and have our money pay us. Okay? That's called retirement for most people. But the problem is that most people spend so much time trading time for money, they never really get to the point of having their money working for them. Because if you really want to change your financial situation, you've got to get that money working for you. Because if it's working for other people, banks, credit card companies, car loan companies, Wall Street, your financial advisor, it's not probably working as efficiently as it could for you. Because when you study the wealthy, which is something that I've been very fortunate to do, when you study what the wealthy do, they focus on, yes, they trade time for money, but their biggest focus is trying to make their money go work for them. Cash flowing assets, a business that they don't have to run that provides cash flow, all that kind of stuff, right? So how do you make your money work for you? Build a system that pays you even if you don't work. And I've been there before, by the way, but I trade time for money because I love what I do, but I've had lots of cash flowing assets. I've had businesses, I've had investments, I've had a lot of real estate that paid me when I was sleeping, paid me when I was not working, paid me when I was even on vacation. Now, that took energy, it took effort, and it took knowledge, right? So that's why we're all here, to learn how to do these kind of things. So how can infinite banking change this for you? For rule number 2, make your money work for you. So that's exactly what infinite banking does. You put your dollars into motion inside your own system, your own banking system, not Wall Street's, not the banks, by the way, and you're going to start earning dividends, and your money's going to grow for you uninterrupted. It's called uninterrupted compound interest. It's going to grow for the rest of your life and keep working for you. And then you have liquidity so that when an opportunity comes up, you can take advantage of it while still having your money working for you inside infinite banking. Because here's the thing. This is kind of a quote that I really like. Money never sleeps. So why should your money sleep? So put your money to work. That's rule number 2. All right. Rule number 3, or the third law, is protect your wealth. If you're not first, you're last. Now, name the movie right there. If you're not first, you're last. It's one of my favorite movies. Hilarious right there. But you've got to protect your wealth, because here's the deal. If you're going to trade time for money, make money, you should also keep it. But that's one of the biggest things, is a lot of people don't understand, how do I protect what I've built, protect what I've made? If you're not protecting it, it's at risk, all right? And so if you're in a recession, which we're kind of heading that direction right now, by the way, if not already in one, timing is everything. Those who prepared early, by the way, for a recession, buy low, sell high, all that kind of stuff. People that can move fast. Protection is actually what matters the most. And a lot of people don't understand how to protect your money. Because people think, well, Brian, I have a trust. Well, a trust, by the way, even a family trust, is not geared towards protection per se. It's geared more towards privacy and estate planning, okay, to avoid probate. People say, what about an LLC? Yes, an LLC is a great way to protect your private assets from your business assets because it draws that line between the two so that if something happens on the business side, they can't go after your personal assets, okay? That's one of the things. But infinite banking, by the way, infinite banking in most states, it's state specific, by the way, is considered a protected asset. So life insurance, because these are life insurance policies, are protected from creditors, divorce, bankruptcy in most states. It is very state specific, by the way, and I believe it's based upon the state that you reside in, not the state that your policy was created in. So I'll give you an example. So I live in Idaho. I'm from Washington State originally. Washington State has one of the worst protections when it comes to life insurance, unfortunately. They have zero protection. In Idaho, where I live now, it's a 100% protected asset. And most states, by the way, are a 100% protected asset. So just keep that in mind. If you're going to make wealth or build wealth, protect it as well. And there's other ways to do that, of course, but infinite banking is one of the ways to really protect your nest egg. All right. Law number 4, wealth will flee its owner if pursuing unrealistic returns. Now, what do we mean by this? This is chasing shiny objects. Hey, I got this cool opportunity. It's going to make 25% returns in 6 months. Sounds too good to be true? It probably is. I also call this one chasing hot tips or chasing the guru, following these people on TikTok, all that kind of stuff. Very, very dangerous. That's how you lose wealth. And by the way, I'll just be very honest here with everybody. I have lost significant amounts of money, over $500,000 in one fell swoop. I remember one time I had an investment opportunity. A buddy came to me and said, hey man, this is a great opportunity. I'm going to get good returns. It's in the tech space. $25,000 was the minimum. I put in $25,000. I lost all that money because what happened was it was in the tech space and it was right before COVID hit. And COVID, if you don't remember, destroyed the tech space because all of a sudden we couldn't get these chips from China and all that kind of stuff. And it just, that business imploded and I lost all that money. But it was promising really good returns. I did not do my due diligence. I'll be very honest because I was trusting a friend. That's one of the things that I always tell people, trust but verify. Trust, but do your due diligence. If I had done my due diligence, I would not have invested in an opportunity. I would have kept that capital liquid for an opportunity like real estate or a hands-on thing that I understood. So wealth will flee its owner if pursuing unrealistic returns. I also see a lot of this in the life insurance space. People are pursuing like an IUL, which is an indexed universal life, because the returns sound really good, but in reality, they're unrealistic. By the way, history has proven that time and time again. So today, I do not chase unrealistic returns. I don't chase the shiny objects. I want to make sure that my money is liquid, it's safe, and it's protected. So, discipline. That is one of those things that I had to learn the hard way many times. Discipline, 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 and patience, by the way. Because sometimes when you see an opportunity, we feel that FOMO, fear of missing out, and we jump on an opportunity and realize, crap, probably shouldn't have done that, and it's too late. And by the way, I've had lots of calls with clients who have the same experiences, and that's why we like infinite banking. So why infinite banking? So infinite banking, by the way, locks your money up, lets it grow, guaranteed, but it also provides you liquidity so that when an opportunity does come up, you can take advantage of it without losing the growth inside the policy. So your money is in two places at the same time. In your policy, growing, protected, safe, secure, legacy, all that stuff, which we'll go through here in a little bit, but it's also outside of the policy, if you want, that's called a loan, working for you in other strategies. So there you go. That's law number 4. All right, what's law number 5? Solve problems to attract wealth. This one is so important. It is so important. What do I mean by that? So go study any very successful entrepreneur, Elon Musk or anybody like that. Study those. What did they do? They solved a problem first that then created their wealth. That's entrepreneurship, by the way, 101 right there. Now, I have a very cool story about this one. This one is a very cool story. So I was speaking at an event. This is, oh my gosh, had to be at least 10 years ago, if not even longer. And there was another speaker there, and he's a billionaire. Okay? And he spoke on stage, and great speaker. And I had the opportunity to sit down and have lunch with this individual. And I kind of asked him, how'd you kind of get your start? What was one of the big things you did that really had a big impact? And by the way, this is one of the guys that created the website Priceline.com. I think it's Priceline.com, and some other big brands that you would know. You would know them all. But he told a story. And this was before you had like those ticket kiosks in the airports. And he remembered he was at an airport this one day, and he was waiting in line to get his ticket. And there's one teller giving out the tickets to people. And there's a huge line of people, and maybe people are getting upset because they don't want to miss their flights, all that kind of stuff. And he's like, there's one teller doing this. And all she's doing is saying, what's your name? Types it in, prints out the ticket, here's your ticket. That's all she was doing. And he got up there and he talked to her and said, hey, what are you doing? She told him, and he turned around and he yelled out to the crowd of people, goes, who here would pay me $10 to get your ticket immediately? They all raised their hand like this right away. And he's like, well, wait a second. So why do we need this teller to do this? Why? This makes no sense. He invented with his company, the airport ticket kiosk machine that we have today. So he was a creator of that. Once again, made him a billionaire again. But what did he do? He solved a problem. He said, there's a problem here right now. People are waiting in line for way too long to talk to this one person to print out a ticket. All she's doing is hitting a button. Why can't they do it themselves? And that's what happened. He solved the problem. So wealth is created by solving problems, right? And that's something a lot of people don't really understand, because if you're trading time for money, you're in a job, maybe it's a job you don't like, by the way, you might not be solving any problem, but the business you work for might be creating a lot of profit because they're solving problems that you're helping do. But that's one thing I always look at, right? So think about this. In your own life right now, what's a problem that I'm talking to you guys right now, that you're uniquely positioned to solve right now? If you had capital, by the way, to start this. Because do you know that more millionaires or wealthy people are created during a recession than not in a recession? Why is that? Because recessions create problems, which are opportunities to solve, which creates wealth, by the way. Because problems are bigger in a recession. Make sense? So the rewards are for those who solve those problems during a recession. So just think about this right now. What skills do you have, or what makes you an expert in something that could solve a problem? Just think about that for a second. Okay? So that's law number 5 right there. The last law of wealth, or law is number 6, is legacy. Share what you know. So here's the thing. So this is something that I've learned over time, is when you teach things that you know or that you're an expert in or things that you have experienced, teaching multiplies wealth, right? And so we make a living by what we get. But we make a life by what we give. That's, by the way, Churchill said that, by the way. So share what you know. So what am I doing right now, by the way? I'm sharing my knowledge, but by sharing this knowledge, it also reinforces in my own life. And so I remember 10 years ago, I did my first webinar about infinite banking. And to date, I've helped thousands of people do that strategy, that concept, which is what I'm doing. But I'm also helping myself in that concept by learning more about it, because the more that I teach, the more I need to go learn. So I go learn something, then I go teach it. I go learn something else, I teach that as well. And so I take what I'm learning, that knowledge, and I pass it on. It makes an impact around me in your lives. So legacy, share what you know, because that will live beyond you. And this is a big thing for me, because I didn't do that for a long time. For a long time, I did not do that. I would go learn something, I would keep it inside, I wouldn't talk about it. But I remember my first experience in law number 6 was in real estate. I went into real estate and I learned how to do a strategy called subject to, which is subject to existing financing remaining in place. It's a way to buy real estate with no financing by using the existing mortgage. And I went and learned that. I paid a lot of money to learn it. And then I started doing that. And I had a lot of experience in it, and I had a lot of fun with it. But what it really took off was when I was at a mastermind for real estate. I was a member of this mastermind, local one. And somebody was asking about that concept. And I explained it, and they said, hey, that's really cool. You explained it in a way that I have not heard before. I thought it was illegal. It's not. And they said, hey, can you actually teach that to the group? I'm like, absolutely. So I did a presentation. I taught it. But what that did is it helped other people do the strategy. But if they needed help, who'd they come to? It was me, by the way. They'd come to me, which gave me opportunities to partner with them to create more cash flow. And that's exactly what happened. So by teaching that concept, other people learned it, wanted to learn more from me about it, and then brought me in to help them do deals. And I made more cash flow because of it. And I remember thinking, my gosh, I taught that concept. What else can I teach that might help people? And the rest is history.
Every single day, your money is losing ground. Inflation is eating your savings. Debt is draining your income. And the financial system, it was never designed to work for you. But there is a way out. And the wealthy have known about it for decades. I'm hosting a free live training where I'll show you exactly how to eliminate debt like the wealthy do, how to preserve and protect your capital from the forces working against it, and how to build a clear step-by-step path toward true financial freedom. No gimmicks, no fluff, just a proven system that puts you back in control of your financial future. Seating is limited and it is completely free, but you need to act now. Click the link below or scan the QR code to reserve your spot today. The wealthy don't wait, neither should you. Now let's get back into the video.
Okay, Max says, what does it mean to pay yourself first? So what I mean by that, Max, is that most times when money comes into our checking account, we say, okay, we've got all these bills to pay, utilities, mortgage, all that kind of stuff. We got to pay all these things first. Whatever's left over is what we save. Versus when your money comes in, pay yourself first. Hey, I'm gonna put $500 into savings. I'm going to put $1,000 into infinite banking policies. I'm going to pay myself first. Then I'm going to take what's left over and pay everybody else. The debts, the creditors, the banking, the bank, the mortgage, all that kind of stuff. Pay yourself first. We're so used to, and by the way, we're programmed to not do that. We're programmed to pay everybody first and then ourselves last. And so my point about that one is that when you pay yourself first, the rest of your expenses will adjust for what's left over. And there's a saying for what that is. I can't remember what it is, but your expenses will adjust for the income. So when you pay yourself first and you have this much left over, you'll adjust your spending accordingly. So that's what I mean by pay yourself first. Mark has a question here. Says, are you still doing subject to? Pace Morby is in that space. Yeah, Pace is in that space. I know Pace. I'm not currently doing it right now just because the economy is in a different place. So subject to is really good when you're coming out of a market, a downturn, like a crash. It's not as good when you're at the very top because the prices have gone up so much that subject to is not as attractive to most potential home sellers. Warren says, my policy looks bad compared to my daughter's policies, but at least I qualified for one at all. Great point, Warren. I appreciate you for sharing that. So what he's referring to is age. So the older we get, the more we've got to put into infinite banking, these kinds of policies, which I'll show you here in a moment, to make them function, right? The younger we are, the lesser amount we can put in. So yeah, so policies on younger people have a lot more time to grow so they can look a bit better. But once again, when's the best time to plant a tree? 20 years ago? When's the second best time? It's today. So don't wait is kind of my information on that one, or my comment on that one. Herman says, what are the opportunities at age 65? It depends on your situation, Herman. If you want to do infinite banking and it's a fit for you, that'd be an opportunity right there. If an annuity is a fit for you, that could be an opportunity there. Depends on what you're trying to accomplish though. So that's my answer to that one is what are you trying to accomplish? And then look at what you have as far as resources go and opportunities go. There you go. And then, yeah, Deborah says, set money aside for yourself first, then pay the other bills second. Exactly. Kelly says, what about a policy at 60? Yeah, that's fine. I have clients that are in their 70s, by the way. So yeah, you can do that. And then Carolyn asks, can you share with a 78-year-old that he can own a policy in someone else's name? Yes, you can. So that's what I was referring to, Larry, is that if you want to do infinite banking, but maybe it's not a fit on you, you can look at doing it on somebody else in your life. It could be potentially a grandkid. It could be a daughter, son, a spouse, even a business partner, somebody else that might qualify better for a policy. But there's other ways to do it. That's why I say, hey, it doesn't mean you can't do it. It just means it might have to change a little bit. And I recommend reaching out and scheduling a call with myself or one of my team members, and we can work with you on that. And then Gary says, what is the cash value for a policy with infinite banking? I'm going to actually show you some examples here in a little bit of policies and the cash value. So you're going to see what they look like. All right, so the next thing we want to cover real quick, I want to cover annuities. Now, why annuities? Let's go ahead and dive into it. So let's look at retirement. Retirement income, your parents versus you. Now, what do I mean by that? So past, and I'm talking 30 years ago, 40 years ago, 50 years ago, retirement looked a lot different than it does today. So in the past, the nest egg, your future nest egg was the smaller amount in your retirement. Social Security was there. That's kind of the middle one that's always there. And a pension was the main way that people retired was a pension. So think of it this way. This is according to the government, 35% of U.S. workers were covered by a pension in 1990. In 2011, it had dropped to 18%. Now, why am I mentioning pensions in retirement? Pensions are guaranteed income. What else was also guaranteed income? Social Security. What is not guaranteed income? Your nest egg. Because what is a nest egg? A nest egg is investments. 401ks, stocks, bonds, real estate, all things that have risk. Present day, the nest egg is typically for most people the largest part of their retirement portfolio. So what is nest egg in that scenario? 401ks. The 401k, by the way, replaced the pension as the main way that people save for retirement. Why did that happen? Because Wall Street and the employers realized, hey, I'm responsible for the pension. That's risk on the employer to provide that pension. If they don't, they're in trouble. The 401k puts all the risk of retirement on the employee. So it was a way to transfer risk from the employer to the employee, and also a cash cow for the IRS and Wall Street. So the 401k, I always say, was one of the, I don't want to say a scam, but man, it really changed the financial future for a lot of Americans, and not for the better. So present day, most people's nest eggs is at-risk dollars, which is kind of scary because when you start taking money out of the at-risk bucket, the value of that bucket goes down. And if you have a recession, it goes down even faster. All of a sudden, oh crap, I'm 67 years old and I'm going back to work. And by the way, we almost all know somebody who's had to do that. I definitely do know people who've done that. And Social Security is still there. Okay, is that going to be there in the future? No guarantees there, but the pensions are very small now because a lot of people don't understand that those don't really exist. Okay, but there's a way where you can actually change your portfolio. So let's kind of get into that for a second. So what is your largest asset? Okay, so there's pensions, Social Security, 401ks, and houses. Those are most people's assets, but most people's biggest asset is what? Anyone take a guess out of these buckets right here? Social Security, a 401k, a home, and a pension. What do most people have that is their largest asset out of these four? Yes, it is a home. You're right. That is absolutely correct for most people. Now let me ask you another question. Does a home provide cash flow? Yeah, in California, especially a house. Yep, nope. A home does not provide cash flow. So your largest asset does not help you in retirement. It provides no cash flow. Chelsea says it's a liability. It can be because guess what? Taxes, insurance, mortgage payments. Okay. Now, Sharon says it can if you have equity, but how does your equity provide cash flow? This is an interesting question, by the way. You've got to invest it. You've got to take it out somehow, but how do you access equity? You got to get approved for a HELOC or a cash out refinance mortgage. You got to go HELOC to invest, or you've got to sell the house. But is that introducing risk now? Yes, it is. On the page here, you see these four assets. Which two are not at risk? Because your house is at risk because it can go up and down in value. You invest the money, it's at risk. You can only access equity if you get a bank's permission. A 401k is in the markets, which is at risk. Pensions and Social Security are guaranteed income. They're not at risk. But that is the smallest portion of most people's portfolio. All right? So Social Security. Now that is the one, right? There's three sources of guaranteed income, which we'll go through. But Social Security, by the way, is one of those things right now that people say might not be there, but it is today. But it's not very much. All right. So here's the thing that I want to get across to all of you. Secure more guaranteed lifetime income, please. This is the one thing that a lot of people do not understand that you can do if you have certain assets. Let me explain what I mean by that. So here's a quote by Time Magazine. Securing at least a base level of lifetime income should be every retiree's priority, at least if they want to live happily ever after. All right? So that's Time Magazine saying that. So that should be the goal, but it's not, unfortunately. So here are the sources of guaranteed income during retirement. There are three of them, by the way, three of them. Social Security, Pensions, which by the way are not very common anymore. They do exist, but they're not as common as they were, 40 years ago. And annuities. Annuities, by the way, I call them self-funded pension plans. Now, annuity guarantees are backed exclusively by the strength and claims paying ability of the issuing insurance company. Now, what do I mean by that? Life insurance companies, not all of them, by the way, but the majority of life insurance companies are some of the most financially secure companies that exist. Because the ones that we use for infinite banking, by the way, have never gone bankrupt, they've never lost money, they've always paid dividends, and they've done that for the entire duration of their existence. They have 100% cash reserves as well, by the way, versus banks that have 10%. So, life insurance companies are extremely solid companies. So, that's why annuities can be very attractive because of their longevity, because of their security, and the guarantees. All right? So, success really depends upon the answers to these two questions. These are two important questions. How much guaranteed lifetime income do you have? And have you taken the key retirement risks off the table? Now, a lot of people, by the way, cannot answer those two questions. So, number one, do you have guaranteed income right now? Or are you going to have guaranteed income in retirement? Do you know how much? If you don't, please grab a time on my calendar and let's have a conversation. Okay? Please grab a time on my calendar, right? Yeah, and Warren, I'll get into that here in a second. How do you fund an annuity? There's a couple different ways you can do that. And Thomas, what companies do we use? When it comes to annuities, it's going to be an A+ rated company. So, and there's a handful of companies. When it comes to infinite banking, it's going to be mainly 3 companies, but we can use about 6, but mainly 3. Lafayette Life, One America Financial, and Security Mutual of New York. Those are the main ones, but there's other ones that we can use. The second question here is, have you taken the key retirement risks off the table? Well, what are those risks? Here they are. So this is why you need secured guaranteed income, because you've got to address these risks. Longevity, that means living too long. Deflation, we know what that means. Market risks, volatility in the markets, so 401ks, pensions, stocks, things like that. Withdrawal rate, so that means how much you're taking out of your 401k as an example. If it's too much and it goes down too fast, that's a risk. Sequence of returns. You have a down market or an up market can impact how much you can take out. So if you have a down market, all of a sudden you cannot take out what you need to live on. Long-term care. That means, hey, I need long-term care because I cannot function daily living, right? I need to have long-term care. That's a very expensive risk. Mortality. That's death, by the way. Inflation, which is obviously inflating of the money supply, which causes rising prices. Regulatory risks and taxation. Do you think tax is going to go up or down? So what's the number one risk here? Does anybody want to take a guess as to what the number one risk is in retirement? It's usually people don't understand what this risk is. So all of these on the screen here, well, Dottie got it right there. Okay, well, she got me. So yes, longevity risk is hands down the number one risk in retirement, longevity, which is living too long. Because the longer that you live, the more taxes go up, the more risk in the markets you're going to experience, the more deflation and inflation you're going to experience. You're going to see all of these things the longer that you live. So how do you take that risk off the table? It's guaranteed income. That's what it is right there. All right? Because it's a multiplier. So longevity is a multiplier of the other risks. So you got to be very careful of longevity, living too long. But most people do not have anything to take care of that risk. That can be very, very scary. Especially today, people are living longer. All right? So how do you reduce longevity risk? So traditional investments, things like stocks, mutual funds, managed money, real estate, CDs, cannot do that. They cannot reduce that risk, by the way. Not unless you get lucky or something like that, because those all have risk. Okay? An annuity or a pension, by the way, with a guaranteed lifetime income can do that. It can remove that risk. All right? What is guaranteed income in lifetime income in an annuity? So think of it like this. Think of it just like a personal pension stream of income. Every month, guaranteed for the rest of your life, or by the way, for you and a spouse or you and somebody else, it's guaranteed income for life. Okay? Pension plan. Now, there are different types of annuities. There are annuities that provide income immediately. Okay? Like so with 30 days later, you fund it, it provides income today. There are annuities that provide income down the road, 5, 10, 15 years down the road. Now you can turn the income on whenever you want, but when you do a deferred income, by the way, the annuity will grow at a guaranteed rate. So this is very cool, by the way, very cool. Let's just say you put some funds into an annuity that's deferred, no income today. It has a guaranteed rate of return, so it's going to grow no matter what the markets do. And these can be some pretty high returns, by the way. I'm going to show you some here in a moment. And then when you turn on the income, then it provides income that's guaranteed for the rest of your life, for you and a spouse as well. So one person passes away, the income continues. Then you have MIGAs, which is called a multi-year guaranteed annuity, which can lock annuity up into funds into an annuity that provides guaranteed growth until you want to turn it into income. So these are lots of ways to do that. And then the last thing I'll mention here is how do you fund an annuity? Because I think Warren asked that question. Cash, obviously, qualified accounts. So you have a 401k, you have an IRA, you have certain types of pensions or investment accounts. You can roll those over into an annuity without any tax consequence because they're tax deferred. So you have a 401k from a prior employer or you're retired, you move the 401k into the pension, you've removed the risk because you no longer are in the markets. You now have a guaranteed growth in the annuity, and then you can turn on income at a later point in time if you want, or right away if you want, but you're removing the risk. So an annuity allows you to take the risk bucket and turn it into a guaranteed income bucket. There you go. Now, Patricia says, what's the minimum amount you can contribute if you are in your 60s? Well, for an annuity, there is no, that doesn't really apply. Now, when it comes to infinite banking, those kinds of policies, yes, there is a minimum. So it's 10 times your age per month is the minimum recommended. Yeah. So Megan says, I had the ball rolling, approved for first lien HELOC and a Lafayette plan, open and funding it, paying off all debts, student loans, only had the mortgage to pay off until my sister's family faced foreclosure, and I could not just sit by, especially with 4 kids. So right back at square one with credit card debt and a HELOC to pay off. Well, I'll be honest, Megan, that's unfortunate that they had to go through that, but I'm also grateful that you were able to come in and help them out. That's amazing because, I mean, I've had families step in and help me out before, and I'm very grateful that they were able to do that financially. So that's why I love infinite banking, by the way, because it can create an opportunity fund for things like that. And I've had to do that before too. I've had to use my policy for an unexpected expense that if I hadn't had that policy there, we would have been in trouble. So grateful that you're able to do that. Okay, so this is a thing we just got yesterday from one of our carriers. And these are 3, 5, and 7-year multi-year guaranteed annuities. So if you put in, so by the way, the amount you put in can dictate how much you get. Okay? So if you put $100,000 into an annuity that's either 3, 5, or 7 years, here's the guaranteed growth of that annuity. 5.8, 6.45, or 6.8%, guaranteed for that duration of time. If you put in less than $100,000, it can be as low as $5,000 or $10,000, by the way. 5.5% for 3 years, 6.2 for 5 years, and 6.55 for 7 years. Pretty powerful, by the way, pretty powerful. And then you can also add in certain things like liquidity riders so that you can take money out of it if you need liquidity. It reduces the return you get, but it makes that still an option that you can pull money out if you need be. But those are some of the returns you can see inside these annuities. So if you guys have like these kinds of funds, 401ks, IRAs, self-directed, cash, capital, that kind of stuff, definitely have a conversation because there could be some opportunities that you might not be aware of that can really change your financial future. Longevity is number one risk of what? So Maribel, great question. It's living too long. So longevity means you live longer than expected because if you live longer, all of the other risks that we mentioned become more because you're going to see more volatility, you're going to see inflation, you're going to see rising prices the longer that you live. Yeah. The long-term care ran out for my parents. They outlived the cap on the service. Yes, it depends. So yeah, great question there, Warren. It depends on how you fund it. It depends on how you fund it. Because there's different types. There's certain, because their annuities, by the way, can have long-term care tied to them, by the way, too. So we can actually do annuities with long-term care riders, but they're not, the long-term care is not forever. It might be 10 years, it depends on that. But you can have certain types of long-term care that don't have an expiration date. They'll provide a guaranteed income for, your lifespan. Depending on when it happens, but there's math that goes into it, by the way. So it depends on how much you're funding it with and all that. But we can do long-term care, by the way, as well. So Marla says, in those annuities on the chart, what happens to the capital after the 3, 5, and 7 years? Thank you, Marla. Great question. I forgot to address that. Thank you. So at the end of the duration, you can choose what to do with it. You can roll it back into another 3, 5, or 7 year multi-year guaranteed annuity. You can roll it into an instant income annuity, so it provides income right away, or you can roll it into a deferred annuity. So so what it does is it gives you that flexibility at the end of the duration to choose what you want to do. Now, do I recommend doing that? It depends upon your age and what you're trying to accomplish. So that's why we have these conversations, because everybody's situation is going to be different. If you're younger, I like the MYGAs a lot more. I'll just be honest, if we're a bit older, we're closer to retirement, I like deferred annuities a lot better, because you want to lock in the guaranteed income right now. Because at the end of 7 years, we don't know what the annuity rate will be at that 8th year. We don't know. But if you're young, you might not care because you're not worried about retirement in the next 20, 30 years. Yeah. What if you pass before it matures? The annuity? So there's options. So there actually can be a death benefit tied to it. The cash flow can be passed on to somebody else. That's called a 10-year certain. They call those 10-year period certains, where you can pass the cash flow on. But once again, the annuity is more for guaranteed income versus legacy planning. Life insurance or infinite banking is more about legacy planning and liquidity. So in annuities and infinite banking, they work together, by the way. They're great when you have both. But they do have each one has their own specific thing. Mark says, what does the liquidity rider do? It allows you to pull money out of the annuity without penalty. So it gives you some liquidity. So if you need to pull it out, you can do so. If you don't have that rider, the annuity might not be liquid. Or if you pull it out, it could cause some fees and things like that you don't really want to do. Deborah says, what about pulling it out and dropping it into infinite banking policy after it matures? Yeah, you could do that, but you'd have to take it as income first. But once again, though, it depends upon how you funded it. There's some ins and outs of that. Depends on how you fund the annuity as to what the tax consequences are when you pull it out. Post-tax or pre-tax funding. But once again, that's kind of getting into the weeds a little bit, but great question. But it's going to be specific for the person and how they fund it, or the funding source. Gary says, annuities for 7 years, is the rate of growth compounded monthly or yearly? No, it's compounded monthly, yeah. Yeah, it compounds. I mean, it's an annual rate, of course, keep that in mind. So it's an annual rate. But yeah, you'll see it grow exponentially. Yeah, good question though. Let's say you have a 401k, and I'm just going to use some round numbers for simple math here, $500,000 in an annuity, or sorry, 401k. Now, how much can you withdraw per year? Well, years ago, it was 4%. Now they're saying 3.3%, but I've also heard now they're recommending 2.8% that you pull out of that. Okay? So if you do the math on that, that's not very good. So you're pulling $500,000, you're pulling only 3% out of that for income. If you roll that 401k 500 grand into an annuity that is guaranteed, it could be 7%, 6 to 7% for the rest of your life. So an annuity will beat a 401k when it comes to income if you follow these withdrawal rates, these kind of recommended rates. So once again, an annuity will beat a 401k in current market economy. Okay, because keep in mind, annuities change. They're every week they change the amounts. Right now they're pretty good. But yeah, so that's something I didn't know. I didn't know about that, and then I learned about that. I'm like, wait a second, an annuity, I can roll it over from my 401k to this and beat the growth over there and the withdrawal rate. Pretty cool, pretty powerful. And there's one here. Okay, this is a quote that I thought was pretty interesting. In the U.S., a 65-year-old male who purchases a life annuity can expect to live about 20% longer than a 65-year-old male who does not purchase one. You want to live longer? Purchase an annuity, because stress around money reduces longevity. So very, very interesting thing right there. So how well would it be sued inside of an annuity? State specific, Deborah. So I'd have to go look that up because it is state specific. Yeah, I'd have to go look that one up. And then Mark says, does it ever make sense to borrow from your infinite banking policy to fund an annuity? Yeah, it can. It'd have to be a fairly large amount though, Mark, for it to make sense. Because there's a lot of other ways you can do that. So yeah, you could do that and then just have the annuity pay the policy back. You could do that. The math you have to math it out, see if it makes sense. But you can do the other way around as well. And I have clients that are doing this right now. They're saying, okay, I've got a 401k. I don't need the income right now, but I'd like to get it locked into it, a guaranteed thing. But I also want to do a policy. So what they're doing is they're doing an income annuity. So they moved it from the 401k to the income side. So now it's got income, and they're taking the actual income from the annuity and using that to fund the policy. So, and now they're kind of like, okay, sweet, I'm hands off. 10 years down the road, they'll take income from the annuity and the policy is self-funded now. And they can use the policy to create more cash flow in investments. So lots of ways to do it. Megan's is saying, I'm not sure I can withdraw a large sum from my employer's 401k. Is that what you're suggesting is a possible source of funding for annuities? Yes. But Megan, that is a challenge there, is that if you are employed with that employer currently, oftentimes you cannot permanently withdraw or do a rollover. But here's what I'd recommend doing. Call up the 401k manager, it's called the custodian, like Fidelity or whomever it is, and ask them if you're allowed to do a qualified rollover out of your 401k into a qualified account. It's either going to be a yes or a no. Because once you leave the employment, then you can roll it over to an annuity right away. But oftentimes, and this is why I do not like 401ks personally, because when you have your money inside one, it's locked up. You cannot touch it. You cannot withdraw it without penalties and fees. Oftentimes, you cannot even pull it out at all. The only thing you might be able to do is get a 401k loan, up to 50 grand or 50%, whichever is the smaller number. So this is the infinite banking presentation. It's going to be a shortened version of it. Some of you have probably seen this one. I'm going to go through this one fairly quick. So this is going to be infinite banking here focused, all right? Now, I always like to ask this question at the beginning. What in life should you want to control? Now, there's 3 things that I believe that you should always want to control in life. So, one is going to be money. Because money is just a tool, by the way. It's just a tool. But if you don't control it, somebody else is going to control it for you. Time. I love to control time, by the way, because it is the one resource that once it's gone, it does not come back, unlike money. So I want to control these things, but money allows me to control time. But the third thing is, to me, one of the most important things you should want to control above all else, and that is your mindset. What is going on up here? Because if you're not controlling your mindset and the things that you believe, that the way you think about money and investing, if you're not controlling that, that means you're being influenced by other people, in my opinion. So you've got to control your mind. So once again, as part of what we do here at the BYOB team is challenge your way of thinking around money and investing in wealth. All right. So this is kind of a funny thing. So this comes from the Social Security Administration. In the United States, only 5% of the population at the age of retirement is financially secure. That comes directly from them. So once again, at the age of retirement, 65 years old, by the way, only 5% or 5 out of 100 people are secure financially at that point in time, which is nuts when we live here in the United States, right? So a big part of what I'm talking to you about, annuities, life insurance, all that kind of stuff, is to make sure that we are part of the 5%, not the 95%, right? Because that's what we want to be. Yeah, and Megan, she says here, the only reason I continue contributing to the 401k is the employer match of 5%. I've been there before, by the way. I've been there before. So I have a lot of clients that they'll do that. They'll reduce the 401k contribution to the match, take that delta and put it into infinite banking, by the way. So it's a way to fund infinite banking policies. Now, infinite banking, by the way, this concept is not new. It's been around for hundreds of years, about early 1800s is when it first came about. But it's talked about in a lot of books. So this is Robert Kiyosaki's book, Second Chance. He talks about it in his book. In fact, one of his advisors was my mentor in infinite banking, by the way. Kind of cool. So I know how their whole world operates. It's really interesting. Tony Robbins, I've been to his events. He talks about it in his book, Money Master the Game. Obviously, this is a book that I do recommend. It's called Becoming Your Own Banker by R. Nelson Nash. He's the guy that coined the phrase infinite banking. And then, of course, we've got my friends and mentors, Brent Kessler and Chris Naugle. They have their book, Mapping Out the Millionaire Mystery, and also the Private Money Guide by Chris Naugle that talks about how to lend through life insurance and that kind of stuff. So I recommend these books right here, by the way. And I do have the bottom 2 books. They're on PDF free, by the way. If you guys want those, just send me an email and I'll send those to you if you want them. So who has used infinite banking through history? I think this is pretty cool. If you guys have seen this, you probably have already seen these names, but it's interesting. So Jim Harbaugh, he was one of college's top paid coaches at one point in time, football coaches, but he was paid through infinite banking. Really cool how they did it. This gentleman, you probably remember him, maybe. His name is Joe Biden, President Biden. So he has 6 policies with MassMutual, one of the companies. He disclosed that when he became president. Walt Disney, back in the early 1900s, he started Disneyland with an infinite banking policy because the banks would not give him financing. So guess what he did? He self-financed the start of Disneyland. Ray Kroc, when he took over McDonald's and was growing the brand, he didn't have cash flow or cash to do it. So he used infinite banking. He had these policies in place to fund the growth of infinite banking or McDonald's for the first 8 years. He became worth like $600 million. Crazy how much he was worth at one point in time. Pampered Chef, so she borrowed $3,000 from a policy to start Pampered Chef. Of course, that brand got sold to, I think, Buffett, and is worth a lot of money today. And lots of wealthy families have done this throughout history. The Rockefellers are probably the most famous ones because there's a book called What the Rockefellers Do that talks about how they did this. But lots of wealthy families, and of course, the average person can now do this. Now, what I want you to understand, though, when it comes to infinite banking, why would you want to consider this? What can this even do for you? So, one, it creates guaranteed generational wealth day one. Not day 30, by the way, not year 30. It's right away, day one. If something happens, guaranteed tax-free, by the way, generational wealth. It allows your money to grow uninterrupted and compounded for the rest of your life, guaranteed. I love the guarantees, by the way. I love those words right there. But yeah, so these policies grow for the rest of your life no matter what you do with them. It takes control away from the big banks, away from Wall Street, and puts that control into your hands. If you want to have more wealth, more financial security in the future, control your money, and that's what this does for you. It protects your money. Remember, if you want to work for your money, you better protect it as well. So this protects it from lawsuits, bankruptcy, divorce, and creditors in most states. As I said, Washington State, you suck. But it allows you to be the bank for things you may normally use a traditional bank for. So think of things like investing in real estate, college, cars, homes, vacations, investments, all that kind of stuff, even retirement. But it does all of these benefits at the exact same time, right? It's not one or the other, it's all at the same time. All right, so as we go through this and talk about money, I want you to understand a few things. What is money? It's just a means of exchange. That's all it is. It's just a tool. Are your dollars worth more today or in the future? We know our money is worth more down the road than it is today. Or sorry, other way around. Your money is worth more today than it is down the road. So think of candy. If you had a dollar bill 20 years ago, they get you a lot of candy in a candy store. Today, maybe half a candy bar, right? So your money is worth more today than it is down the road. So you want to use it as much as possible today. Will taxes go up or down? They're not going to go down. I mean, look at our government spending right now. They're not going to go down most likely. They're going to go up in most cases. And if your 401k is tax deferred, right? What's that mean? It means you're going to pay more taxes down the road than you would today. So infinite banking is actually not tax deferred. It is tax-free growth. What do you know about your retirement account? I just explained it. It's tax deferred in most cases, which means, one, you don't control it. It's normally at risk, and you're going to pay more taxes on those dollars down the road. So once again, that's why I mentioned annuities at the beginning of this, because annuities remove that risk, provide that guarantee. And Gary has a great question. The annuities is offered by what type of insurance company? All different types of insurance companies offer them. But what we want to go with is A+ rated companies, because there's ratings on insurance companies. And so we will look at the different types of companies, what they offer, how they're structured, all that kind of stuff, and make sure they are a top tier rated company and they're not 5 years old. They have to be older companies, they've been around for a long time, always been profitable, all that kind of stuff. But that's something I review with people when we're looking at quotes. Because I've actually told people, said, yeah, that company has a great return, but I would not recommend them because they're a rated C, which is really bad, by the way, really bad. And so we don't even typically talk about those kind of companies with clients. We just talk about A+ rated companies. But yeah, but they're going to be companies that, ones you typically have heard of, usually. Yeah. All right, so let's talk about how money flows if we're going to be our bank. Now, I'm going to go through these examples pretty quick here. So let's look at a transaction of buying a car. So let's say you're going to buy a $25,000 car and you have $25,000 of cash in your local bank. Typically, you would go take the money out of the bank and go buy the car, and then you would take $500 per month and save it up into your savings account again to replenish your savings account. Makes sense. But what if something happened? What if it was different? What if you went to the bank and the bank said, hey, before you take this money out, what if we did this for you? Leave your money in the bank. We will use that cash as collateral for a loan. We'll give you a loan, but we're going to give you 4% on the money that you leave in the bank. So once again, the bank's going to give you a loan of $25,000 at 6% for 60 months. That's $500 per month. And they're going to pay you 4% on your $25,000 of cash for 60 months. Does this make sense? Well, once again, it's just math. How does it math? Monthly payments on the car loan are $483. Future value of all those payments is $28,999. What's the value of the money in the bank? $30,525, which means, by the way, that you made $1,526 by not paying cash for the car, but getting a loan, because your money at 4% is growing and your money at 6% on the loan is actually, that balance is going down. It's compound interest. Simple interest versus compound interest. The loan is simple, the growth is compounded. So, but what if you're the bank on all sides of this transaction? It can make a lot more sense. So once again, it's just math. So once again, I'm challenging the way that we think around money. So we're going to go through the machine. What is infinite banking? We're going to go through the wealth journey. How do we build wealth with this? And then how do we create a legacy with infinite banking? All right, so what is the machine of infinite banking? So I want you to think about this. I want you to think about infinite banking like a car. A car has wheels, it has brakes, it has seats and a radio and a windshield and all that kind of stuff. But what does a car need, or the infinite banking car, need to go down the road? It needs an engine, okay? What is the most efficient engine for the infinite banking car? It is a specially designed, dividend-paying, permanent whole life insurance policy from a mutual insurance company. Now, we have tested other types of engines. IULs, which is indexed universal life. ULs, 401k loans, other things, cash, by the way. Nothing beats a whole life policy. It is the best engine and has been the best engine for over 150 years. All right. So now, who's the biggest purchaser of infinite banking policies in the US? It is traditional banks. So the banks that you see on every corner and every street buy life insurance on their employees. They own, by the way, more life insurance than they do their buildings and real estate combined. And they do not buy IULs, they buy whole life insurance policies because it is the best vehicle for this. All right, now I'm going to go through this slide pretty quick. So when you give money to a bank, you no longer legally own the money. The bank does. I don't know if you knew that, but it's kind of creepy. But yes, the bank owns your money when you give it to them. And they do not sit on that money. They put it to work. So if you give bank 100 grand and they pay you 4%, they do not sit there. They do this. They put that money to work over and over and over and over again to the point where they make 500% more off of your money than they're paying you. So, does it make sense to be the bank? Yeah, absolutely. Because guess what? They are making between 400 and 1,300%, according to BauerFinancial.com, on the money that you give them. That is staggering. Okay, so what I want to do real quick here, I'm going to show you an example of buying a car with a policy. Now, this is a policy right here. This is what a policy looks like. So, on this one, you've got a $10,000 going in every month. So once again, that's just an example. Your numbers are your numbers. On a call, I will discuss your numbers with you. As you fund the policy, you're going to have what is called cash value over here. So I want the majority of every deposit you put in going to the cash value, growing that cash value right there. All right. Now, these policies also earn dividends. The dividends between 5 and 6%, they come in every 12 months and they are calculated on your prior deposits, and they fund and build more cash value. So you can see this down here. Look at year 8, 9, 10, 11, 12. No more deposits going in. What's happening to the cash value? It's going up. It's still growing. Even though you're not putting anything in, the dividends are compounding your cash value. All right. Now, you'll see this thing called deposits. We don't call this an expense. We call it a deposit, the premiums, because you get value out of it. Age. A lot of people look at life insurance and say, oh, am I too old? Potentially, yes, but that's in your typically mid to late 70s. But age is not the biggest factor as well. Death benefit. It is a benefit. We don't focus on it, but it is a benefit. We focus on the living benefits first, but we also do talk about the death benefit. All right, this right here, this is an actual illustration of the policy that I'm showing you right now. Once again, 10,000 goes in for the first 7 years, nothing after that. Cash value keeps on growing, and also, look at this. The death benefit keeps on growing as well, which is awesome. So these are not a flat death benefit type of policies. The death benefit goes up along with the cash value. So 30 years down the road, that death benefit could be 3 times what it is day one or more. All right. All right, so I'm going to show you an example of buying a car with a policy and how this works. It's just math, by the way. So $10,000 goes in per month. Here's the cash value. In year 3, at the end of year 3, you say, hey, I'm going to go buy a car for $25,000, and I'm going to be a responsible banker, by the way. I'm going to pay myself back with interest. Okay? I'm going to pay back $500 per month or $6,000 per year. So what's the math look like in the first 7 years? I put in $70,000 via the deposits. I put in $30,000 back into the loan. That's $100,000. But guess what? I also took out $25,000 in cash. That's cash in my hands. So in reality, and by the way, I bought a car with that. I could have bought a piece of real estate. I could have bought a mobile home. Doesn't matter. It's just cash. But that means I put in $75,000 into this policy in the first 7 years. But look at the cash value. It's $71,000, which means I have recaptured 95 cents of every dollar so far. But in the next 5 years is where this thing gets really powerful. Let's look at the next set of years. In years 8 through 12, 0 goes in. But guess what? The cash value keeps on growing. So let's say in year 8, you go buy a car for your daughter. My daughter's turning 16. Lord help me. So let's go get a car. $25,000, same thing. We pay it back with interest. So what does the next set of 5 years look like? $30,000 went into the loan. You took out $25,000 of cash, which means you put in $5,000, but between years 7 and years 12, the cash value grew by $16,888. So you put in 5, but you got $16,000 of buying power back out of the policy. But here's the other thing I want to point out. How much have you put into this policy in the first 12 years? $75,000 here and $5,000 here. That's $80,000. What's the cash value? It's $87,000 and growing every year, and you own 2 cars 100% outright with no banks involved. But your money's growing. You're building wealth by when you're doing the other transactions. So once again, this is a very simplistic example of how this can work for you. So 3 rules with infinite banking. Pay yourself first. Remember, that's one of the laws of wealth right there. Pay yourself with interest. If you're going to be a responsible banker, pay it back with interest. And recycle and recapture your money. What that means is if you're going to do banking transactions or banking functions in your life, use your own banking so that you can recycle your money through the policy and build wealth at the exact same time. All right. So this next example, I'm going to go through this one pretty quick. This is debt. So one of the biggest things people use infinite banking for is getting rid of bad debt, which by the way, I've done the same thing. So in this example, I'm not going to go through every single slide because it takes some time and I want to get into any Q&A you guys have, any questions. So in this example, this is a doctor, a chiropractor who has a lot of debt, $478,000, almost $6,000 per month, and almost $70,000 per year he's paying out. So if he paid off these debts as scheduled, it'd take him 19 years and he'd be not building wealth at the same time. All right. So what's he do? So in this one, he's doing a $25,000 per year premium policy. Now, if you're saying, Brian, where did he get the $25,000? I don't have that kind of money. He's a doctor. Keep that in mind. Your numbers are your numbers. These are his numbers. But he actually redirected funds that were going to a 401k, and he put them into the policy instead of the 401k. So his cash flow didn't change. But what he's doing is every year he puts in money, he's getting cash value in the policy. Okay? He's taking that cash value out as a loan, and he's paying off certain debts strategically. And he's reducing his monthly payments. The amount that he reduces his monthly payments by, which is $448, he takes that amount of money and he pays back his policy to increase the cash value again. So in year 2, puts in 25, cash value goes up, payments back to himself also are added into this. Cash value available is more now, 21 grand, keeps paying off debts. He does this year over year over year. And so what you can see happening is year over year, he's borrowing more from the policy, monthly payments go down, debts are getting wiped out. His policy loan is going up in value, though, by the way. So he's increasing his loan balance on his policy. But here's what happens, and I'm not going to go through every slide here, okay? So here's year 4. Once again, payments drop down. Look at this. By year 6, beginning of year 6, look what happens. He's wiped out all of his debts, monthly payments are gone, and there you go. Now, what does he do during year 6 and year 7? Well, he's got a policy loan. So he takes the $5,777 that he's not paying to anybody else now, and he pays back his policy loan. So by the end of year 7, he's 100% debt-free and has multiple 6 figures of cash value in his policy that he can now do what with? Put it to work. Make his money work for him now. Not 19 years, by the way. He did it in less than 8 years. He did it in about 6.5, 7 years. He did this. Very powerful. By the way, his cash flow did not change. He just changed where it was going. The first thing he did was paid himself first, not the 401k, himself. And he benefited immensely. He saved, oh my gosh, I don't remember the math, but it's hundreds of thousands of dollars of interest he would have paid otherwise that he now saved building wealth for himself. So a very simple example. Now, if you're saying, well, Brian, that's a lot of numbers. How do you do that? We have software called the Vault, by the way. You may have heard about this. It shows you how to do what I just showed you. It'll map the whole thing out from beginning to end. And we can do that for you, by the way. All right. And by the way, we also have on our team an implementation team. These people work with you on how to use policies after the fact. There's no cost, no fees to that. Excuse me. But yeah, they'll show you how to use the policies. So if you need someone to guide you on how to use infinite banking in your life, that's what we do for you. All right. So now what? What if I don't have bad debt, don't need a new car? Can I still benefit from doing this? Absolutely, by the way, because that is when it gets a lot of fun, because that's when you put your money to work. All right. So here's how people will use infinite banking to build wealth outside of, major purchases and getting rid of bad debt. So real estate investors, wholesalers, flippers, buy and holds, all that kind of stuff. Commercial property, so think of like apartments and mobile homes. By the way, mobile homes is what I want to get into next when it comes to real estate because I like that strategy. Private funds and lending, so private passive real estate, things like that. Business owners for like lines of credit, using it for retirement strategies, things like that. Stocks and options traders. I've done day trading, which I don't do it anymore, but I have clients that are doing options, by the way. Startups, so I have clients that have used these funds to start up a business, and then even equipment flipping, buying cars, flipping them, things like that. All right, so here's what I want to do next. I want to show you an example of an actual illustration and numbers and how it looks when you're doing something like private lending. Okay, so in this example, there's a lot of numbers here. I'm going to break it down for you. This client is a private lender already. They have funds, they're private lending already to real estate investors. But what you're going to see here on the left-hand side is the contract premium deposit column. Now you'll notice these do not go up over time. In fact, they go down over time. Unlike other types of life insurance, these have a decreasing premium, not an increasing premium or flat. You'll see in the first year, $150,000 premium and then $50,000 per year thereafter. What does that mean? This is a $50,000 annual premium policy, and this client is doing a $100,000 dump-in or lump sum dump-in in year one. What is that? So you have the option on these policies to overfund the cash value day one. It's called a dump-in, or sometimes they call it a lump sum PUA. But when you do that, this guy did $100,000. 90% of that went to the cash value. Within 30 days, he was borrowing it back out again. So it's very quick. Additionally, the dividends are a lot higher on this policy because there's a large deposit day one. But let's go and look at how this policy looks down the road, because as these policies grow, they become more and more efficient. By year 8, the cash value grew by $66,000 and change. That's how much his cash value grew by. You can see it right there. And you can see the cash value available to him every year right here in this column as well. But what did he fund it with that year? Well, his cash injection in year 8 was only $48,000 and change, which means the policy grew by 18 grand versus what he put in. That's a 37% cash on cash return, which is pretty phenomenal. But check this out. He's a private lender. He's already lending money at, I think he said 12%. Yeah, 12%. He's lending 12%. Is 37% more than 12%? Absolutely. But what happens if you combine those returns? So let's look at this example. He's lending the cash value out at 12% to a private borrower. He's earning 37% cash on cash in that given year, and he's paying 5% back on the policy. That's a 44% cash on cash return on his money, which is a phenomenal. What did he change? Where his money went first. That's the first thing he changed. So the question for this client was, hey, would you rather make 12% or 44%? His answer was 44%, of course, because he's like, okay, this is insane. I can make that much more return. That's insane. And by the way, that cash on cash return goes up every year. Doesn't go down, it goes up more and more and more every year. So that's an example of how a policy can be used for investing. All right. And by the way, our software will map that out. So if you have an investment opportunity and you want to say, what's the best way to use my policy? The gain projector software inside our Vault software will show you how to do that. All right. Now, I believe that everybody should learn about infinite banking. I truly do, because it is one of the best ways I have ever seen to safeguard your wealth, secure it, and make it liquid at the same time. All right. So once again, infinite banking, this is kind of a goofy little picture here, but it makes your money work for you no matter what. If you're sleeping, your money's working for you. It's growing no matter what you're doing. So infinite banking is one of the best ways I have seen to do that, but also keep your money liquid so that you can take advantage of opportunities when they do show up. So some other things about infinite banking that I want to make sure that we do cover real quick here. Death benefit. That is a guaranteed legacy, by the way, because with these kinds of policies, the death benefit is tax-free and guaranteed. It is not guaranteed with other types of life insurance, by the way. You control the loans. I'm going to talk about that here in a moment. The internal values grow tax-free. I don't mind paying taxes, but I'm a lot happier paying a lot less. The policies, as I mentioned, they are exempt from judgments and liens in most states, and they can provide tax-free income in retirement. So let's talk about the legacy part of this for a second. So on this policy over here, you'll see this person is putting in $20,000 per year for the first 5 years. After that, they drop it down to $3,257. So once again, they can drop it down. But look at the death benefit. It's going up every single year. Year one, $20,000 went in. There's a $325,000 death benefit. God forbid something happens to this client in year one. Her beneficiaries or her family are going to get $325,000 from $20,000. Year five, $100,000 has gone in. By the way, the cash value is almost $100,000. It's growing. Death benefit is $483,000. It went up from $325,000 to $483,000. Look at year seven. $3,257 goes in. Cash value jumps up by $7,000 and change. Death benefit has still gone up. Pretty cool how these things work. They keep on growing. These have guarantees. A lot of other strategies do not have this level of guarantees or growth. So once again, this is why we like infinite banking as a strategy. Policy loans. They are guaranteed, by the way. These loans are guaranteed. The last one that I took, it took me 30 seconds to request the loan, and it showed up 24 hours later. There is no credit check. There's no approval. Ask and you shall receive. They are very quick and very simple. The loans are private. They do not show up in your credit report. Unlike a credit card, car loan, etc., those are on your credit report. These are not. They're private loans. There are no minimum or maximum payments. You are the one in control of the loan. So unlike a car loan, you have to make a payment. With these ones, you don't have to make a payment. Should you? Yes, but it depends upon what you're doing. You might not make a payment this month. You don't have to. Miss a payment? Nothing happens, by the way, because there is no payment required. All right, how can you fund the policies? All right, you can do them monthly, quarterly, or annually, as I mentioned. There's a minimum and there's a maximum as to what you can qualify for on a premium deposit. The minimum is 10 times your age per month. The maximum depends upon the individual, but roughly speaking, it's about 20% of your gross revenue divided by 12 for monthly. So once again, the maximum, roughly 20% of your gross revenue. So 100 grand per year, 20% is 20 grand per year, divided by 12 is what? 166, I think? Yeah, something like that. Yeah, $1,660 is the maximum. So 10 times your age, and then there's that math right there. On top of the premium, like I mentioned on that prior slide, you can fund a policy with an upfront and dump-in. It's up to you. You don't have to. Optional thing to do. But 70 to 90% of what you fund the policy with in the first 30 days goes to cash value. So it's not you're waiting 3 years to borrow from these policies or even 1 year. You can borrow right off the bat. Now here's an example of another policy, just to give you some numbers to look at. So this one is $10,000 per year annual premium and a $50,000 lump sum dump in. You'll see year one, 60 went in. That's the premium plus the dump in, 60 grand. At the end of that year, these are end of year numbers, by the way, including dividends, the cash value available is $55,000 and change, which means this person has access to more than 90% of what they put in that first year. But look at year two. In year two, they put in $10,000. At the end of the year, the cash value has grown by $10,607, more than they put into it. So they are cash on cash positive by year two because they put in that $50,000 lump sum dump in. But let's look at year 11. Year 11 is pretty cool. They put in $3,120 because of dividends and compounding, by the way. The cash value goes up by $10,590, which is more than 3 times what they put into it in that given year. Gary, great question right there. Year 8, the death benefit drops down right here. He's seen that right there. You'll see the premium drops down as well. I'll do a very brief explanation of this. This is called the Modified Endowment Contract Limitation or Rule. What that means, and this is an IRS thing, by the way. So it's called the 7-year MEC test. What that means is that in order to avoid any taxes, we have to make sure that we don't hit what's called the MEC limit. The MEC limit is a calculation based upon how high the death benefit is for those first 7 years and how high the cash value is for those first 7 years. If those two numbers during the first 7 years get close enough to each other, it'll become a MEC policy, which means every loan is taxed. We do not want to do that. We don't want to trigger a MEC. So in order to do the large $50,000 dump in, which jumps up the cash value, we have to increase the death benefit temporarily for those first 7 years to not trigger that MEC rule. So inside the premium, we have a 7-year temporary term insurance rider, which means is we have an amount of death benefit added to the policy for the first 7 years, but once we're beyond year 7, we no longer need that term rider, we drop it off. So the death benefit, that temporary death benefit goes away at year 8. So that's the brief explanation. If that didn't make sense, if we were on a call, I can explain to you a bit more. But it's a way to make the policy more efficient, very quick, very quick. But great question. I'm glad you caught that. So this is a quote that I'm not sure if Warren Buffett said this, but I always want to share it because I have a different quote that I prefer. And his quote is this. It says, "If poor people would just do what rich people do, they wouldn't be poor anymore." Well, I don't like that because I don't like the term poor, by the way. I don't really like that. But they can't do what the rich do because the rich have different, opportunities. They have different access. So not my favorite quote, by the way. Here's my quote, and this is by someone named Brian Fouts. That's me right here. And I like this one. "Your financial future is shaped by the knowledge that you gain and the actions you take." Because knowledge is great, but without any action on the knowledge, nothing is going to change. So you've got to take action on the knowledge that you gain. And if you're here right now, we've still got 88 people on. If you're here right now gaining knowledge, take action on it. Don't just sit here and say, "Oh, that's great, I got some more knowledge," and then keep on doing your same thing. Because if you want it to change things in your life, you've got to change what you're doing. And this is a way to do it. So once again, take action on the knowledge. Why would you work with me on any of this kind of stuff, by the way? So I've been teaching infinite banking for about actually 10 years now, 10 years. We have an entire team that works with you to set up infinite banking. So by the way, our team, we are the largest producer of infinite banking policies in the US. So we know what we're doing. But we're not like 100 people. We're less than 20 people in our core team, by the way. I have currently about 100 clients in underwriting with annuities and infinite banking, by the way. We do provide ongoing support and services, so keep that in mind. And there's no cost to you, so we don't charge you anything to work with me to do annuities, to do infinite banking policies. Now, our Vault software does have a subscription if you want to use it, but you don't have to. All right, so the other question I get quite a bit, and I only have like a couple more slides, just so you're aware, is an indexed universal life, IUL by the way, or a VUL, which is a variable universal life infinite banking. No, they are not infinite banking. Those are very young products. They've only been around since like 2000, something like that. They're not they have not been around a long time. IULs and term insurance, by the way, pay a lot of commission versus infinite banking. Infinite banking pays about 70% less in commission than traditional insurance. But that's why there's room to grow the cash value, because we cut down commission, there's more room for cash value. Okay? But yeah, IULs and things like that, they are not the best fit for infinite banking, and this comes from personal experience owning ULs, by the way. I have had those, and I do not recommend them at all. They do not work for infinite banking. And we only do infinite banking when it comes to life insurance. We don't do IULs. We can do term insurance, by the way, if it's a good strategy for the client, but we don't do IULs or VULs. We only do whole life policies, and of course we do annuities and long-term care. So this is the last slide here. I always like to end on this one. So in life, there's going to be one of two things will happen to us. Now, both things will happen. But the first thing is that we are going to live. We know that. We are alive right now, okay? So are we better off with or without infinite banking in our life? 100% we're better off with it. If it's a fit for you, by the way, if it's a fit. We also are going to die. We know that. Are we better off with or without this in place? Well, if you understand the tax-free guaranteed death benefit that creates legacy, we're better off with this in our life. Okay? All right. Any questions you guys have for me on this? And by the way, the next steps would be just to hop on a call with me, and then I just put the link in the chat box right there. Just hop on a call. Let's solve your problems and just see if infinite banking is a fit. Because I'll be honest, it is not always a fit for you. And if it's not a fit for you, I will definitely let you know. Okay? But yeah, it's just hop on a call with me and let's just see if it's a fit and go through your situation and see if we can solve your problems. Ron says, is infinite banking transferable? So it's a life insurance policy. So that's a great question. Let me kind of break it down for you. So when it comes to any kind of life insurance policy, there's three people involved or three entities involved. The first, of course, is the insured person. That's the person the policy is based on. That cannot transfer, okay? Because the whole thing is based upon that person's life. Cannot change that. The second person is the owner of the policy. Who's the owner? Well, guess what? That's typically going to be the insured person, but it can be somebody else if there's insurable interest. If the insured person is a 10-year-old child, the owner is typically going to be a different person, has to be, and it's going to be the parent. That owner can be transferred. Within limits, by the way, but you can change the owner of the policies. Within limits, by the way. The third entity involved is the beneficiary. The beneficiary can definitely be changed throughout the life of the policy. It can be one person, can be two people, can be one person and an entity, could be a trust, could be a charity. Any of those things can apply. Any of those things can apply. But great question. But otherwise, the insured person cannot change. So, yeah. And then when the insured person passes on, so when they graduate, as we call it, the policy matures and then it's done. It's closed. So then the death benefit is paid out and the policy is done. So you cannot transfer a policy when the insured person passes away. That's not possible either. Great question, Kelly. So she says, can someone older put this kind of policy on you without you knowing? No, they cannot. So it's funny. You ever watch like movies and they say, oh, this person got murdered. Oh, they found out that the husband or spouse just opened the policy on that person and then paid a hitman that would kill him to collect the death benefit. That's not true. You can't do that. So because let's say that it's a husband-wife situation here. And let's say the husband is going to be the owner of the policy and the wife is going to be the insured person. The insured person, who's an adult, has to sign off on the application and has to go through the application process and do the medical exam. So there's no way they can do that. They cannot open that up. The only caveat to that, Kelly, is that if you are a parent and the child is a juvenile, all right? Juveniles cannot sign off on anything. So if you want to get a policy on your child, yes, you can get a policy on your child without the child knowing about it because they cannot sign off on it. You as the guardian have to be the one that signs off on the application. But that's the only situation where the insured is not aware of the policy. It's for juveniles. Yeah. But otherwise, in pretty much every other case, the insured person is part of the application process because they have to be. Yeah. And yeah, T. Harris says, knowledge is power. And I like that quote, right? Knowledge is power, but here's my follow-up to that quote or that saying. Knowledge is power, but knowledge plus action is powerful. Because action to me is taking the knowledge and putting it into play, putting it into action, I guess I'd say, or put it into the world, right? So unless you do that, then the knowledge doesn't do anything. Yep. Yeah. Absolutely, El Parker. I appreciate you saying that. Yep, absolutely. Yeah, and I know I kind of went through the last part pretty fast. I did on Tuesday this presentation for Infinite Banking. It's a longer version of it with more slides and stuff. If you guys want to watch that one should be on our YouTube channel here in a couple days as well. It's called Take Back Control Tuesday. Go check that one out. It's the same presentation I just did here on Infinite Banking, just a bit longer. But I did go through a lot of stuff today. I went through the 6 laws of wealth. We went through, obviously, the annuities, and then went through Infinite Banking. So if you guys want to chat about any of that kind of stuff with me, grab my information, grab my call link, grab my email, whatever you want, and then reach out. Yeah, take Back Control Tuesday. And by the way, I'm getting ready to do a longer annuity presentation on our take back control here, probably next month or so. I want to do it this month, but I'm not sure if I'll do it probably in August. But we're going to be doing more on the annuity side of stuff because it's very powerful. And right now, I'll be honest, the rates fluctuate on annuities, and the rates today might not be the same in 6 months. And so if you're even considering an annuity, I would recommend scheduling a call, because if you say, oh, I'm going to wait, a couple of years, the rates might not be 6%, they might be 4% in 6 years or 6 months or whatever. We just don't know. But right now they're pretty good. And in fact, they actually went up a bit, which is awesome. So we're not seeing, in the current economy and markets, we just don't know how long these rates will last. So just recommend, if you have any interest, just grab a time with me, and I'll grab my information and put it there again. There's my email address right there. And the next one I'll put in here is my personal call link, which will land you on my calendar. All right, any other questions? Going once, going twice. Oh, and by the way, so we do have our Ask Me Anything here at 4:30 Eastern. So here in about 2 hours, we're going to have that as well. So if you guys want to attend that, go and subscribe on our YouTube channel, and you'll get informed when we start that live stream. And or it's on, I think it's on Facebook too. I think on Chris's YouTube or Facebook channel as well. Yeah. Yep. We call it the happy hour. Ask Me Anything happy hour. It's kind of funny. We call it happy hour because we started that back in COVID, when everybody was stuck at home. And it was happy hour because they'd have beverages and drinks and stuff. But now it's typically just, water. So, but yeah, definitely recommend hopping on that as well. All right, everybody. Appreciate all the questions. Appreciate all of the input and feedback, and look forward to talking to some of you on a call one-on-one. And we'll see you in our next live event. Take care, everybody.